What's going on, everybody? Joel here with the Richards Mortgage Group, and I'm back after way too long trying to create some new content to hopefully bring you guys some value and provide some insight into the Canadian mortgage and real estate market. I've officially ran out of excuses and ways to procrastinate doing this sort of thing. I've gone out and bought myself a brand new webcam. The market is slow enough over this summer that I actually have a little bit of free time so I can do this sort of thing. So without further ado, I'm going to jump straight into it and talk to you guys today about an acronym that I came up with to help me with conversations that I have with clients to help explain why I have to ask the sort of questions that I do in order to determine whether or not they can qualify for a mortgage and how much they can qualify for. So that acronym is SPICE. It stands for Strategy, Property, Income, Credit, and Equity. And these are the variables that lenders are going to look at when they're determining whether or not they want to give you a loan and how much of a loan they're willing to give you. Jumping straight into it, S stands for strategy, which is what exactly is it that you're trying to accomplish with applying for mortgage financing. So there's lots of different real estate strategies that you might be interested in. So maybe you're a first-time home buyer trying to buy their first home in the city, or maybe you're trying to acquire a rental property, or maybe you want to buy an acreage or more rural type property, or maybe you're interested in new construction, or maybe you already own a home and you're trying to refinance that to pull out some of the equity in order to buy something else or maybe consolidate some debts. There's lots of different real estate strategies, but for me as a mortgage broker, it's very important that I understand from the get-go what it is that you're trying to do so that I can match you up with a lender and a lending product that's a good fit for your situation and what it is that you're trying to do. Moving on, P for property is the characteristics of the property itself that we're going to be looking at. So when we're talking about a pre-approval, we're going to talk about things from a high level. So that's kind of what exactly is the property type that you're interested in. So are you trying to buy a single family home, maybe a condo, townhouse, maybe something more rural, as I mentioned before. There's lots of different property types and different lending nuances that come into play with each different property type. But also, once we're actually looking at a specific property that we're trying to finance, so either you're going out to make an actual offer to purchase, or if we're refinancing, then it's the actual property that you own, then it comes down to certain characteristics of that specific property that may make that property more or less financeable with certain lenders, and some lenders may like it, some lenders may not. And certain characteristics such as, for example, preserved wood foundations or knob and tube wiring, poly B plumbing, asbestos insulation. These things may make your property less desirable for certain lenders, and other lenders might not have an issue with it. So it's important to understand the specifics of that property that we're looking at in order to determine which lender is a good fit for it. So that's property. Moving on to I for income. So income is important relative to both the new debt that you're looking to take on, so that's the mortgage payment plus property taxes plus heating and utility expenses plus all of the other liabilities that you have as well. So this could be things like vehicle loans, credit cards and lines of credit, student debt. Maybe you have support and alimony payments from a previous relationship. There's lots of different types of liabilities that you might have, but lenders want to make sure that you're bringing in enough income each month in order to cover the new mortgage plus all the other liabilities that you have, plus have a little bit of wiggle room left over in case unexpected expenses arise. So lenders are going to look at things called your debt to income ratios in order to determine how much new debt you're able to take on. And for different types of loans with different types of lenders, there's going to be different debt to income ratios that they're going to look at. So I won't get into that right now. I'll save that for another video, but just know that lenders are going to look at the ratio of your monthly liabilities or your monthly payment obligations in relation to the amount of income that you're bringing in each month. So that's income, very important. Moving on to C, which stands for credit, also quite important. So credit is important from a lending perspective because they want to see that you have a reliable track record of when somebody lends you money, you pay them back on time and as agreed. Now that's not to say that you have to have an absolutely perfect credit history. Lenders understand that mistakes happen, blips happen, and so maybe you missed a phone bill payment, or maybe you had a credit card that you paid late 1 month because you forgot to set up automatic payments or whatever else. Lenders understand that mistakes happen, so you don't have to have a perfect credit score, but they do want to understand your credit history and the reasons behind why your credit is the way it is. Even in some cases, more serious credit issues such as bankruptcies and consumer proposals, there may be a lending solution that works for you. But again, we just need to understand upfront what it is we're working with so that we can place you with a lender and a loan that's a good fit for your situation. So that's credit. Moving on to E for equity. Equity is important to lenders because it protects them in two different ways. First of all, equity is skin in the game that you bring to the table. So in the case of a purchase, equity is going to be the down payment that you put down in the property in addition to the loan that the lender is supplying. And in the case of a refinance, equity is going to be existing equity that you already have in the property. So basically the difference between what it's worth and what you already owe on it. But that skin in the game protects lenders because when you have something to lose, if the lender were, say, to foreclose on you and repossess your home, then that acts as a disincentive to you to be late on payments or to default on your loan. When you have something to lose, you're going to take all measures necessary in order to make sure that that mortgage payment gets paid on time and that you don't lose the home through the repossession process or the foreclosure process, I mean. The other way that equity protects lenders is that it serves as a buffer for them. So if they did have to foreclose on you and repossess that home and sell it in order to recoup their funds, the equity is what would get eroded first if, for example, the lender couldn't sell the home for as much as it was originally worth. So, for example, if market conditions have changed and the home's now worth a little bit less than it originally was, or maybe as part of the foreclosure process, you cause some damage to the home and reduce the value that way. So maybe the lender can't sell the home for as much as it was originally purchased for. Well, it's that equity that gets eroded first, and the lender still has a higher chance of getting their money back, even if they have to sell it for a bit less than it was originally purchased for. So that's the other way that it protects lenders. So those are the 5 variables that we're going to look at when we're determining whether or not you can qualify for a mortgage and how much mortgage you can qualify for. I'm going to take that one step further and talk about a useful way that I think about these 5 variables, which is I think about a chair or a table. So you've got the 4 legs, you've got the tabletop. So on that tabletop is where the strategy is going to sit, and it's the other 4 legs that are going to hold up that strategy. So for any given strategy, there's a combination of property, income, credit, and equity that is going to combine in order to successfully hold up that strategy. And in some cases where you might have one leg that's a little bit weaker than the others, as long as the others are very strong in order to compensate for it, there's still probably a financing solution that's going to be a fit for you. So maybe you don't have a lot of down payment, or maybe you have a somewhat unique income situation that's not a fit for all lenders, or maybe you've had some past credit blips. Well, in all of these cases, if the other 3 legs of the chair or table are very strong, then we still have a good chance of supporting that strategy. But when we get into situations where we have multiple weak legs, so maybe you have bad credit and not much down payment, or you have a difficult to finance property and a unique income situation, that's when it starts getting a little bit harder to find a financing solution that's a fit for you. So multiple weak legs starts to reduce the odds of us actually finding a financing situation for what it is that you're trying to do. But I find it's very useful to think about these 5 variables in this way. So that's the video. I hope that you found it useful. I hope that you got some insight in it. If you want to reach out and chat a little bit further about anything related to mortgages and real estate, feel free to send me an email at joel@richardsmortgagegroup.ca, or reach out through any of the social media platforms that you might find me on, or you can find us at richardsmortgagegroup.ca on the web, and just reach out. We'll start a conversation and we'll start figuring out whether or not there might be a financing solution for whatever it is that you're trying to accomplish. So hope you enjoyed the video. I will be making more of these in the future. Let me know what you thought, and for now, have a great rest of your day.